So as you all know that on 18th of February, the India UAE CEPA was concluded. Concluded as in it was signed on that day. However, it is expected to be in force from May 2022. However, having said that, can everybody hear me? Because I'm seeing some messages like my internet is unstable. Am I audible?
Yes, you are audible, Shweta.
Oh, okay. Because I was getting the messages that my internet is not stable. That's why. Okay, so it is expected to be in force from May 2022. However, before starting, I would just want to let you know that any trade agreement, when it is signed between two nations, it itself does not become applicable even though a date is given for its implementation. For that agreement to come into effect, both the countries, or if it's a multilateral agreement, then all the countries, they have to bring out the relevant notifications in the relevant laws. If, say for example, if the exemptions are given from the customs duty, then the law has to, then the regulations, the notifications have to come in for in the customs law to give that effect. If there are any other benefits, like for the pharmaceuticals or for any other regulatory aspects that is being, like for education, if any other regulatory aspects that is being given in the agreement, so for that also relevant notifications, regulations, laws will have to be framed, and only then it can come into force. Merely by saying that the two countries have signed the agreement will not suffice to make the agreement effective. It is just that both the countries have agreed to certain clauses wherein they agree to extend cooperation to each other in various aspects which are agreed in the agreement. So though it is, though the ministry has said that it is expected to be in force from May 2022. So if actually it has to be in force from May 2022, then this month itself we should see, or from 1st of May, we should see some of the notifications in the customs law and the relevant laws, which will make the provisions of this agreement effective. So can anybody tell me here, what is the difference between a CEPA and a FTA? CEPA is Comprehensive Economic Partnership Agreement, and FTA is a free trade agreement. Can anybody tell me the difference? Because here I have mentioned few bullet points which should indicate you as to what is the difference between an FTA and a CEPA. Okay, so let me tell you the difference. An FTA, when we say free trade agreement, so that agreement pertains to only goods. First thing, it is not a comprehensive economic participation agreement, partnership agreement. So FTA is only for goods. The other country will give some benefits to the import of goods of the other country into their territory, and this happens both ways, but it is limited to only goods and not to other aspects. Like, it is not a sort of a partnership between the two countries. But when we talk about CEPA is a more comprehensive agreement. It covers almost each and everything, and it's basically like you're participating in the economy of the other country. So both the countries, when they come together and sign a CEPA, so both the countries get easy access to the services, to the IPRs, to the investment. They open the investments for both the countries. They open up the digital trade between both the countries, digital ease of doing business with respect to making of the digital payments between the two countries. Then the customs procedures are relaxed between the two countries. Then there are technical barriers to trade, as in like, I'll discuss one by one in between. So CEPA is the first thing we need to know is that CEPA is a very, very comprehensive agreement. So this agreement also, it's an 880-page agreement, almost 900 pages agreement. So today, while dealing with the session, we will be actually dealing with more towards the goods and the customs angle, because if we are to discuss on each and every aspect of this agreement, 1 or 2 day workshop might be required, and that cannot be done in a 1 hour session, 1.5 hour session for this the entire agreement. So today we will more be focusing, which is our key area also, because maximum benefits are provided there itself. But definitely I'll be touching upon all the aspects so that at least some things are clear to everybody as to what all things this CEPA contains with respect to UAE. So this CEPA is typically contains rules of origin, because the benefit is given to the goods which are originating in either UAE or India. So but how to determine those rules of origin, we'll be dealing in the subsequent slides. Trade in services, there are various service sectors that are being opened to the other country, and in fact not only the services, but giving recognition to the educational qualifications also of the other countries. So if somebody is qualified in India, then that will be recognized in UAE also, from doing the servicing there, providing the services there, or setting up a business, his service center there, from where he can provide the services, practicing in that particular country. So aspects like giving recognition to the CA profession, CS, legal, doctor, architecture. So there are various professions that have also been covered while taking into account in the trade in services. Then there are these technical barriers to trade. These objective of these technical barriers is to trade is typically to ensure that there are no obstacles that are created by way of standards, technical regulations and assessment procedures. Say for example, though both the countries have agreed to typically provide the custom duty-free entry to the goods of the other country, but say their assessment procedures are so so harsh, or they have a different level of assessment level technical regulations which are required, or typical standards which they have prescribed for the import are altogether different, which they give to their domestic goods. So in that case, just merely by giving the duty concession will not suffice, because otherwise those countries have imposed the technical barriers to trade. So when there is a comprehensive agreement, the countries also ensure that there is easy flow of the goods between the two nations by removing the technical barriers to trade. And secondly, like there are certain standards, certain assessment procedures which are set out by the WTO, so which the countries have to agree to it when they enter into these kind of agreements. So in that case, if any country is not abiding by those standards and it wants to have a different standards set of standards for itself, standards or regulations or checkpoints or assessments whatsoever, so in that case they need to clearly specifically mention that these will be the technical barriers which they will be putting on the imports from India or something like that. So if tomorrow, basically now the countries have agreed that whatever the technical barriers would be there, those will be in line with the WTO norms, and they will not be violating any of the WTO norms with respect to the technical barriers to trade. Which in simple words, if we say that no country can frame the laws or its regulations or assessment procedures or something like that in such a manner which favors its domestic, which favors only one party and doesn't favor the other party, and thereby it's imposing a technical barrier at that point. Similar are the sanitary and phytosanitary measures, which both the countries have agreed. Sanitary and phytosanitary measures are typically wherein these animal, human health and these things they have agreed to protect, and according to the standard guidelines they will be agreeing in which they will be setting up the complete mechanism, and so that there is both the countries abide by and commit to protect the sanitary and phytosanitary, undertake the sanitary and phytosanitary measures. And if there is any violation, then definitely there will be various committees with whom the reports, the complaints can be filed. The other aspect would be the dispute settlement, which this agreement deals with. Dispute settlement is how the two countries, if there is any dispute pertaining to the agreement, then how that dispute settlement would be done, what would be the committees, whom they have to approach, and all that stuff. So as of now, definitely we won't be going into the dispute settlement mechanism. Similarly, deals with movement of natural persons, people moving from India to UAE, people moving from UAE to India, how easy it has to be for the purposes of doing any kind of business. Otherwise, for tourists, it's all okay, but this pertains to more of for the purposes of doing the business. Then there are detailed guidelines pertaining to the telecom sector as to how each country can deal with the telecom sector of the other country. Similarly, they have set out some customs procedures. We'll be dealing in detail in the subsequent slides. Here, I'm just giving a brief cutout of the agreement. Then pharmaceutical products. This is the first time which it has happened that there is a separate annexure in the agreement itself, which provides the recognition of the pharmaceutical products of the other country. So, and like there are a lot of benefits, the recognitions, the licenses, which typically the Indian medicines, Indian pharmaceutical products would be getting in UAE. Similarly, if there are any pharmaceutical products being manufactured in UAE, they would be getting the benefit in India. So this is how both the pharmaceutical sector in both the countries would be benefited. Let me tell you, before this UAE CEPA agreement, though India has previously signed CEPA agreement with like Japan, it has concluded a CEPA agreement with I think South Korea, it has concluded a CEPA agreement, but none of the earlier agreements is so comprehensive to cover, like when they provide for the benefit to the pharmaceutical product, it's just like mere some small benefit. But here in this agreement, to the pharmaceutical sector itself, by way of investment, by way of recognition of the license, by way of requirement of licensing, by way of registration, how the product, how the the testing and everything. So there's a separate chapter itself, separate annexures itself, which governs the pharmaceutical products in the in this CEPA. And earlier that has not been the case till now. One chapter deals with government procurements. One is specifically for IPRs, as to how the intellectual properties of one country would be recognized in the other country. Investment, how both the countries would open up their gates for investment. And digital trade. Digital trade as in like, it also includes the digital payments, digital invoicing, and many other things. There's a complete chapter on this. So this is the first bilateral trade agreement in the Middle East and North Africa region, which we call it as MENA region. So till now, there is no such agreement with the Middle East countries, and definitely not with African countries we have. So this is the first bilateral trade agreement, and that too at such a comprehensive level, which is typically, I would say, till date, there is no such comprehensive CEPA agreement. Also, one more point to mention here is that India has also signed a CEPA agreement. It's typically CESA, Comprehensive Economic Cooperation Agreement, with Australia also on 2nd of April recently. So however, the documents are yet awaited on the websites, the official documents. It's just that they have signed it. So, and many more are in the pipeline also. UK is in the pipeline, Canada is in the pipeline, EU is in the pipeline. So there are many agreements which are in pipeline also, which we hope to see in near future. Does anybody has any question on this slide? I would want that questions are being asked on slide by slide so that we can discuss. Okay, so I'll move forward. Now we'll come to the benefits, what these countries offer, as to how the benefits they have negotiated with each other. This covers almost all the tariff lines dealt in India, 11,908 tariff lines, and the UAE 7581 tariff lines respectively. So when the goods would be imported from UAE to India, on 11,908 tariff lines, the benefit has been given. When goods would be imported into UAE, on there it's 7,581 tariff lines respectively, which they have given the benefit. Number wise, one should not confuse, because it all depends upon what kind of trade is being done from India to UAE and UAE to India. But yes, a lot of, means almost entire customs tariff has been, your products qualifying almost in entire custom tariff has been given. But yes, there are many exceptions as well. India will benefit from the preferential market access provided by UAE on over 97% of the tariff lines. So this is how big the number is. India will also be offering preferential access to UAE on over 90% of the tariff lines. So UAE is giving benefit on its 97% of the tariff lines. Tariff lines, when I say, I'm talking about the tariff which they have, and each and individual tariff entry. So UAE would be giving benefit to Indian goods on 97% of its tariff lines, whereas India is giving benefit to UAE on 90% of the tariff lines. separate annexure on pharmaceuticals to facilitate access of Indian pharmaceutical products, especially automatic registration and marketing authorization in 90 days for products meeting the specified criteria. So as I mentioned in the previous slide also, that for the pharmaceuticals, this is typically for the first time that such kind of CEPA is being entered, that which will recognize the Indian pharmaceuticals and will provide them automatic registration within 90 days. Obviously, they have to meet certain criteria, and if those criteria are met, then in that case, UAE will have to grant a quick registration, automatic registration, which I say, to the Indian pharmaceuticals. Now we'll be starting with trade in goods. There are certain key terms. When you will see, I will be sharing the tariff in a tariff also. So there'll be certain terms which you will be seeing, which are frequently used in the tariff elimination schedule which they have provided. One is TEI. TEI is tariff elimination immediate. So let me tell you, though this agreement does not have any timeline as to like till what time the benefits would be continued to be given. However, as of now, the schedule of benefit has been given for next 10 years. It does not mean that after 10 years it will automatically stop or something like that, but it could also mean that after 10 years, whatever benefits were there at the 10th year would continue thereafter. Or the government might come again with some other modified or amended schedule. So, but as of now, they have provided a schedule of 10 years as to how they are looking forward. So they've given a plan typically, if I say, for the next 10 years. So TEI is tariff elimination immediate. These are those products on which the tariff elimination will be immediately given, 0%, which is completely 0%. So if today they are being subject to customs duty, say at 15%, 20%, 10%, whatsoever, but when this agreement comes into force by way of notifications in the Indian law, then in that case, the benefit on those goods which come under TEI would be 0% immediately. And that will continue to be for the next 10 years. Then there is TEP, which is tariff elimination phased. So they have given a 10-year schedule as to how the phasing would be done. Like say if today the goods are subject to a duty rate of 30%, then maybe in the first year they'll say they'll provide a benefit of the duty would be levied at the rate of 25%. Then they'll say at third year would be 20%, fourth year would be 15%. Fifth year would be 12%, then 7%, whatsoever. So it is in a phased manner, and gradually the tariff would be eliminated completely at the end of 10 years. So it is tariff elimination. It's not reduction. It's elimination in phased manner. TR is tariff reduction. For the goods qualifying under tariff reduction, the benefit would not be complete exemption from customs duty, whether immediate or in a phased manner, but it will be at a reduced rate. And reduced rate can be immediate also, reduced rate can be in a phased manner also, but it will never go to 0% of the duty. EXE, there is a list, there is against each item you can find that there is written something like EXE. So for the goods against which it's written EXE, it means exclusion. That means those very goods are not covered within the benefit to be given under this agreement. TRQ is tariff rate quota. So tariff rate quota. So in this, the government has in fact fixed tariffs, rate quotas for particular items, and the benefit would be given only till that tariff rate quota is met. And if if the imports take place beyond that, then there will be no benefit that would be given. So they have defined a limited quantity to which the benefit would be given. How that would be worked out, we need to see in the subsequent notifications when they will be rolled out as to what kind of tariff rate quotas are being rolled out. But there are many products in tariff rate quotas also. Any question on this slide? Okay, so I'm moving further. Import into India and export from India. So I've divided into two parts. Import into India, if we see, it's a 362-page schedule which has been provided along with the tariff entries and everything. As I told you, this is an 880-page document, so this is also part of that. Benefit is given for next 10 years. I've already explained. Benefit on import into India given at 8-digit level. So when you see the schedule which has been provided, it's given properly at 8-digit level, which is according to the Indian customs and which will be duly incorporated when the notifications come out. Standard rate of duty here in India, as we know, is 30%, and over 90% of the tariff lines are covered for the benefit. I'm just sharing the import schedule once with you so that you can have a look at it as to how it looks like today. I'm sharing the screen, just a second. Can you see my screen?
Yes.
Okay, so this is Annexure 2A, which is provided, which provides for schedule of specific tariff commitments of India on trade in goods, which is referred to in Chapter 2. So this is how they have provided item by item at 8-digit level. This is how they have given the 10-year schedule. So effective rate, what would be the effective rate? And what is the standard rate? Like here they say, talk about standard rate, then the effective rate, then tariff modality offered. This is what I was talking about, TEI, TR, TEP over 5 years, and what's the plan, and then the schedule of tariff rate concession. So initially when the notifications will be rolled out under the customs law, they will typically provide you the schedule. They will not provide you for 10-year schedule. They will typically incorporate only the portion on which the benefit would be given at that point in time. So, but gradually every year the notifications would be coming for this kind of giving effect to each year's rate. So this document itself is I'll just zoom in. This document itself is a 362-pager document. So at many places you will see like it's a EXE. So where it's written EXE, there no benefits would be given to you. And majority of the products, they are in TEI if we see, but it's not the case that all the products are in TEI. So depending upon chapter to chapter, item to item, from chapter 1 to chapter 98, for each and every 8-digit classification, they have provided as to what would be the treatment that would be given to that particular tariff heading. Any questions on this? Okay, so I'm again sharing back my screen of, I'll share the import schedule from UAE's perspective also. Can you see?
Yes.
Okay, so this is the schedule which they have provided when the goods are imported into UAE, meaning thereby when you export the goods from India and imported into UAE. So similar to India, they have also provided a 10-year schedule, and on what all products, and definitely this classification is the classification which is given according to the UAE law. So as I think we all know, that you must be knowing that globally the HSN classification at 6-digit remains same, but thereafter the discretion is given to the countries to adopt their own either 8-digit classification. Some countries even have 10-digit classification, and at 8-digit also, our 8-digit would be different from the 8-digit classification in UAE. So this classification is as per the UAE. So if anyone is evaluating whether the imports from UAE or exports from India to UAE, then accordingly it has to see whether for each and every item, whether the benefit would be given to them or not. And if they have the UAE tariff entry here, so they have to correspondingly see what would be the corresponding entry here in India, and then accordingly, what is their tariff heading here in India, they have to accordingly see what would be the tariff entry in the UAE customs. So I'm coming back to the PPT. So I think it's visible now. Wherever my voice is breaking or I'm not audible, please just say it loud that your voice is not audible, ma'am. Can you please repeat whatever you have said? I'll just repeat it for the sake of everybody's information. So this is how the import schedule and export schedule for both the countries have been framed in this. Interestingly, the standard rate of customs duty there in UAE today also, otherwise it's 5%, as against ours, which is 25 or 30%, but standard rate there in UAE is 5%. So, but the point is that if you export now and your goods are covered under the benefit, then instead of that 5%, you will be given a 0% benefit. So there will be a saving of 5% approximately. Keynotes. There are certain provisions which have been provided in this agreement with respect to certain products which would be allowed to be imported duty-free into their country, despite the fact that the goods are of origin of those countries. For these also, I would say that there has to be specific notifications which needs to be rolled out. So temporary admission free of customs duties. One is professional and scientific equipment and materials, including their spare parts and goods for sports purposes that are necessary for carrying out the business activity, trade or profession of a person who qualifies for temporary entry pursuant to the laws of importing party. So typically if a person is entering, so with him physically these items are permissible into the country of each other if they are being imported temporarily. Goods intended for display or use at playgrounds, theaters, exhibitions, fairs or other similar events, including printed materials, films and recordings. So these will also be allowed only with UAE. Containers and pallets in use or to be used for refilling. This is a very, very contentious issue at times when it comes with the customs. So if you are importing any containers or pallets which are in use or are to be reused for refilling, then in that case, there would be no customs duty. Machinery and equipments for completion of projects or for conducting the experiments and tests related to such projects or for repair. So for these purposes, if the goods are coming temporarily, then in that case, they will be allowed free of customs duty. Goods entered for completion of processing. One important aspect, and this is one benefit which is being given to temporary admission. The other duty-free entry of commercial samples of negligible value and printed advertising materials. So today, if you're importing any sample also from outside India, even though you have to declare, even though there is no consideration for that, but still you have to pay customs duty on that because there is typically no exemption on that, on the import of the commercial samples. So they will be typically defining a value. As of now, it's not known that the countries are free to govern in their notifications. So they'll be defining a value up till which the commercial samples can be imported duty-free from the respective country. Samples to be imported for solicitation of orders for goods or for solicitation of orders for services provided from the country. Advertising material subject to conditions. The conditions, obviously, there are certain conditions which are prescribed here and more conditions would be prescribed when the notifications would come out. Goods returned or re-entered after repair or alteration. Re-enters within 1 year. Customs duty to be applied on addition resulting from repair or alteration. Here, I understand few of you may ask a question that now also, if the goods are going out for repair or alteration, and then if they are returned, still there is no customs duty benefit. But let me tell you, the time period there given is 6 months. But for this agreement, it says that both the countries will have to give the benefit of re-entering for 1 year. So I understand that there would be specific notification which grants this kind of benefit specific to UAE, imports from UAE. And again, I would repeat that these are regardless of origin. So if you are importing goods from that country, then in that case, whatever is the origin of that country, if they have been imported, say in Dubai from somewhere else, so even then this benefit would be given. Now we'll deal with some key concepts in the India UAE CEPA. Because to understand the concept of origin, it's very important to understand these concepts first. So the 362 pager and the other export schedule, which I have shown you in the previous slide, the benefit on those goods would be provided only if the goods qualify for origin of goods under this respective CEPA, if they qualify for the condition. So in this case, origin of goods is typically divided, is governed by, not divided, rather governed by 4 main conditions. One is non-qualifying operations, the other is minimal processes, the other is wholly obtained, and next is product-specific rules. So though they have in this agreement made separate separate clauses for non-qualifying operations and minimal processes, but typically both of them typically means that there are certain processes which, if carried out in that particular country, will not qualify for giving the benefit on of origin to those particular goods. So I'll be sharing as to what all those minimal processes and non-qualifying operations are. So this is the list of minimal processes that have been given. Like if you're doing some sort of packaging or assembly of packages, washing, cleaning, removal of dust, oxide, then for textile, attaching accessory articles, straps, simple painting, polishing, sharpening, packaging, peeling. So these are a list of activities given. Just a second. These are a list of activities given, which if you're doing in a country, then even though these activities are done in that country with the help, and there is a value addition over those goods, but still those will not qualify for the purposes of the rule of origin, and they will not qualify to be the goods of that particular country. Important to note is that any combination of 2 or more operations in some paragraph. So even if you're doing all of these activities or any of these activities, so those will still not qualify. Non-qualifying operations, mere dilution with water or another substance that does not materially alter the characteristics of the product. Or this is next is a residuary clause. This B clause is a residuary clause, and this is very important, wherein it says that if there is any doubt with respect to the production or pricing practice being followed in that particular country, and there are evidences with the government or the person, the authority issuing the certificate of origin, that they are adopting these kind of practices merely to circumvent the provisions of this chapter. So in that case, they will not provide the benefit of the certificate of origin. So this kind of clause I have not seen in any other CEPA agreement or FTA agreement which India has concluded with any other country. This kind of clause, at least as far as I know, I am seeing it for the first time, that there is a residuary clause also which gives a discretionary power to the authorities, basis which they can, even though it does not qualify to be the minimal processes, still they can deny. Any questions still here? No questions? Wholly obtained. Okay, let me just tell me, am I clear? Am I able to explain what I'm trying to explain? So I'm still not getting the answer.
You are going very fast in speech, madam.
Okay, I'm running very fast in speech. Okay,
Yes,
okay, I'll try to go slow. Okay, wholly obtained. There is other category of the goods which qualify as wholly obtained. Wholly obtained, though in English language, if we see, we see that, okay, wholly obtained means that particular good should be wholly obtained in that country. But what is the meaning of wholly obtained? So this term has been defined in the agreement. This term typically these are the things which qualify to be wholly obtained products. So these are, if in short I explain, these are typically those items which are more of naturally occurring items, like plant products grown and harvested in the country. So if in India there are certain plants, some herbs which are growing, and those herbs are being exported to UAE, then in that case they will qualify as wholly obtained products. Similarly, animals, if the animal is raised and born and in one particular country, it is a wholly obtained. Mining activity, sea fishing activity, marine products, so articles collected by in the party which no longer can perform their original purpose nor are capable of being restored or repaired, and are fit only for disposal or recovery of parts or raw materials or for recycling purposes. So there are various categories here which are given, which will qualify as wholly obtained. More interestingly, I would say that it's a good part which is not there in other FTAs or CEPA agreements, is that once there is a separate schedule which is given, I will be sharing that also in my subsequent slide, which specifically says that the goods belonging to one particular chapter, do they need to qualify as wholly obtained or do they need to qualify under the product specific rules. So you need not see whether actually under which they should qualify. So normally, given my personal experience, so I've seen that there are companies when they are getting the certificate of origin issued, so the information what they give to the department, they will write it as they are wholly obtained, even though they are some manufacturing some kind of article. It's not a naturally occurring substance in the country, and maybe due to any because a lack of knowledge, or maybe due to any hurry, the department also allows them for wholly obtained. So but here in this there are specific products which are given under the wholly obtained, and if your item is qualifying under a different chapter heading, then in that case it cannot be a wholly obtained product because it's not written there. It has to be a PSR. PSR is product specific rules. Next is the product specific rules. So product specific rules have been provided chapter by chapter. They have provided the specific rules as to how those product specific rules have to be complied on each and every product, and accordingly they will be given the certificate of origin from the respective authority. So in India you will have to apply to the authority to get the certificate of origin, and if say your item is falling under chapter 84, in that case the product specific rule for chapter 84 will have to be fulfilled. I'll be sharing the product specific rules also here. So I'll be just stopping my PPT here and sharing a PDF again here. Is my screen visible? Okay. So these are the product specific rules that have been given. So if you see chapter 1, chapter 2, they necessarily have to be wholly obtained. WO is wholly obtained. Thereafter we see against some chapters, you must be seeing that CTSH plus VA 40%, CTH plus VAs. Somewhere you will also see CC plus 40%. See here it is CC plus 40%. So I'll explain as to what these are. CTSH means change in tariff subheading. So at 6-digit level, there has to be a change. So if your product say is falling under any 6-digit level, if I take for chapter 9 products. So if your item is falling under any 6-digit level of chapter 9, so for your product to qualify for the certificate of origin of made in India, of origin in India, then in that case, there has to be a 6-digit change in the chapter heading. And plus value addition, VA is value addition 40% plus value addition of 40%. In subsequent slides, I'll be dealing with as to how to calculate this value addition of 40%. But let's understand first from here that what is the meaning of CTSH plus VA 40%. So CTSH is change in subheading, which is a change in tariff subheading, which is at 6-digit level, plus value addition of 40%. So both these criteria needs to be fulfilled. So when I change in, that means your final product and your raw material. So if there are, say, 3 raw materials which are going in for the manufacture of a final product Y. So in that case, all the 3 raw materials need to have the change in tariff subheading at 6-digit level, and plus the entire process should result in a value addition of 40%. Only then your goods will qualify for certificate of origin. CTSH is change in subheading. CTH is change in tariff heading. This is the chapter itself. So if you are, say, your raw material belongs to chapter 11, and then there is your final product belongs to chapter 13, then in that case the raw material should be completely transformed from one chapter heading to the this is change in tariff heading. So one chapter heading to the, just a minute. Yeah, this is from 4-digit level. So from 4-digit level, at, say, in chapter 11 itself, there must be minimum 4-digit level change. So minor processing may not work because minor processing may actually not lead to change in the tariff heading of that particular product, or if it leads to a change, it might just lead to a change in at 6-digit level, not at 4-digit level. So 4-digit level should change. So wherever it is written CTH plus VA 40%, it is change in tariff heading. Wherever it is written as CC is completely change in chapter. So products of, say, chapter 19 should be transformed. If your final product is, say, in chapter 20, then your raw material HSN should be chapter 19. Your final output HSN should be chapter 20. Only then this condition will get satisfied. As far as the value addition is concerned, I will come to that in my subsequent slides. So these are the 3 major criteria that are given. And if this is chapter by chapter which is given, and sometimes at even 4-digit level it is given. So wherever, whatever is your heading, depending upon that, you will have to fulfill the criteria here. So is there any question here? Am I clear in this as to how to read the product specific rules? Okay, so I'm moving forward. I'm just stopping this share and coming back to the PPT. Screen is visible. So these were the product specific rules. Now let's come to as to how that value addition needs to be calculated. This is the value addition criteria for PSR. FOB value or ex works price minus value of non-originating material, norm is non-originating material, divided by FOB value or works ex works, or then there is a second material formula which is given, which is cost of originating material, direct labor cost plus direct overhead cost divided by FOB value or ex works price. In fact, this is the first time in like I am seeing that in any FTA, the basis is also given for ex works. Otherwise, in all the FTAs where I've seen normally, maybe there are some exceptions which I've not really gone through, but normally the all the calculations are being done on FOB value only. So this is the formula which is being given, whether the item is originating or non-originating. When we say non-originating material, when we say cost of originating material, in both the cases, whether it's non-originating or originating has to be determined in the light of this agreement itself, as to what is the definition of originating, what is the definition of non-originating. So if, say, for a particular item, it's given VA CTSH plus VA 40%, then your raw material of cost of any is calculating the cost of originating material. Originating material here is your raw material plus direct labor cost plus direct overhead cost. So in that case, that particular raw material should also meet that particular criteria with its manufacturer from whom you have obtained it. From whom you have procured that particular raw material. So this is the formula which is typically given for calculation of the value addition. Anybody has any question here? Okay. There are, while determining the origination of any good, there are certain criteria given for certain specific kind of goods, and sometimes not only the certain specific kind of goods, but also for certain specific concepts that are being used in the FTA to determine the origination and non-origination. Such criteria is accumulation or accumulation. So is anybody aware of what this accumulation is typically? How is it applied in any FTA? Okay, so let me explain. There's this concept of accumulation, meaning thereby here, like India and UAE, they both have entered into the agreement. So if there are any goods which India has exported to UAE, and there is a manufacturer in UAE, and he manufactures the final goods from that particular raw material, and then he again exports it to India. So in that case, the benefit of accumulation would be given to his raw material. His raw material is what? His raw material is the raw material which he has procured from India. So it could be many times cases like there is a manufacturer in India. He is importing, say, 10 different raw materials and having a manufacturing facility here in India. One or two of the raw material is being procured from UAE also. And since the final goods are being sold to UAE, in that case, while taking the values for non-originating material or originating material. So since he is importing 10 raw material, 2 of them are imported from UAE, and 8 of them, this is just an example, and 8 of them are imported, say, from other countries. So in that case, while calculating his non-originating material and originating material, raw material, those 8 items, those 8 raw materials will be, value of those 8 raw material will be taken into the non-originating material, and the value of those 2 raw material, which he is procuring from UAE, will be considered as an originating material. This is a kind of a deeming fiction which is being provided. The benefit is typically because since these are the 2 countries who have collaborated, so wherever the raw material arrives, it really doesn't matter. So that is the reason why they have given this benefit of accumulation and accumulation. So so I hope I'm clear on this concept of accumulation and accumulation. Somewhere they use the word accumulation, somewhere they use the word accumulation. Then there is this indirect material. Indirect material is goods which are not physically incorporated in the final goods, like fuel, plant and equipment, molds, etc., shall be neither originating nor non-originating. So for doing your final calculation of value addition, in that case, you're not supposed to take any, there is a complete list. I've taken it as etc. There is a complete definition of indirect material, and it's a complete list which has been given. So you're not supposed to take any of those values while calculating the value addition of that particular product. Because these are neither to be treated as originating nor to be treated as non-originating. The key reason typically is, like, if we talk about plant and equipment, those plant and equipment could be at times used for exporting to, like if I'm a manufacturer here in India and I am exporting to UAE also, I am exporting to US also, UK also, Australia also. So obviously it's not that my plant and equipment is only used for manufacturing for UAE products. It's used for many other countries also, for domestic selling also. So that is the reason why those values are to be ignored and not to be taken. Any question here? Then there is this consignment criteria. Consignment criteria is that most FTAs lay down that goods should be directly consigned from the country of origin. Directly, you have to import your goods directly from UAE to India to get the benefit, and vice versa. It cannot happen that the goods have actually originated in UAE. The party has also got a certificate of origin from its respective authorities there in UAE, but thereafter, maybe say for some minor processing, it goes to Singapore, and then the company here in India is importing the goods from Singapore. So even though the goods have the certificate of origin of UAE, still those goods will not be given the benefit here in India. So goods have to be directly consigned from UAE to India. However, there is one exception to it, and that exception is typically, I'll be dealing in the subsequent slide, that particular exception. But as a key rule, the goods should be directly consigned. It should not happen that they are going to some other country for some kind of processes or something and then coming to India for the benefit to be taken. Retrospectivity. The CEO can be obtained retrospectively after the goods have been dispatched. Normally, the case is that CO has to be obtained before the dispatch of the goods, because in original they have to be sent along with the goods. Also means they have to reach to the importer also, and which definitely, if you all are aware of the Carotar provisions, they have to be physically shown to the authority sitting at the customs, and they deface the original certificate of origin also. So it has to be obtained before, it should be normally obtained before the goods are dispatched from that particular country. But there might be certain cases where the certificate of origin couldn't be obtained due to any reason. So in that case, there is a provision that they can be issued retrospectively, however, and that too after the goods have been dispatched. But there will be a scene of retrospectivity on the certificate of origin, and at times practically we have seen that if there is a seal of retrospectivity on the certificate of origin, meaning thereby that the authority in the other country, the issuing authority in the other country, has actually not seen the goods, they have not verified, they have done nothing, typically just on the basis of the documents they have given. So in that case, at times we have seen that people while importing have faced problems also. If the goods are with retrospectivity, and the customs views it with a eye of suspicion, even though they view everything with an eye of suspicion, but if it's written issued retrospectively on the certificate of origin, then they specifically view it with an eye of suspicion. Then there is this important rule of de minimis rule. De minimis rule, first let me explain what is the meaning of de minimis rule. So de minimis rule is typically like, I'll explain you with the help of an example. Say you have 4 raw materials which are going into the manufacture of a final product. Okay, so of these 4 raw materials, one of the product is such that it is not qualifying for the PSR. It is not qualifying for either CTH or CTSH or CC, whatever is the case applicable to it, to the final product of which is mentioned in that PSR schedule. So in that case, this de minimis provisions come to the rescue. So these provisions, they typically provide that the value of the non-originating material in such cases, if it does not exceed 10% of the value of the goods or the ex-works price of the export product. So in that case, particularly, they will qualify to be the originating goods. So that condition will not be said to be violative, that because your raw material is not transforming from one HSN to the other the other required HSN. So therefore, we will not give you the benefit. It will not happen if that particular value does not exceed 10% of the FOB value. Definitely, it cannot be the case that say a raw material A is actually of the 60% value of the final product, FOB value of the product, and that it is having the same HSN. The raw material is also having the same HSN, the final product is also having the same HSN. Then in that case, the benefit of de minimis rule will not be provided. So if it is not exceeding 10%, then that particular raw material can be typically ignored while doing this calculation of origination and non-origination. So there is a different rule provided for de minimis for chapter 50 to 63, which are textile products. And then for the other goods, they are providing a different rule, which is typical standard rule of 10%. Otherwise, for textile products, they provide that 7% of the total weight of the materials used in the production of the exported product, or 10% of the FOB. So weight wise or the value wise. This is how they give the de minimis rule for chapter 50 to 63. For wholly obtained product, they say the de minimis rule is 1% of the FOB value of the X works, because wholly obtained typically means you are actually obtaining it naturally. There might be certain minor processes which after taking it out, maybe you are cutting it, packing it, you are freezing it, you're doing some kind of minor processes, and thereafter you are exporting it. And in doing those minor processes, there are certain raw materials also which are going into that. So for that, it says that for wholly obtained product, your de minimis rule should not exceed 1% of the FOB value or the X works price of the exported product. Any confusion in this de minimis rule, or I can move forward? Am I clear on this de minimis rule? Okay, so nobody is answering me. I think either I'm clear or nobody is understanding. These two only could be the consequences. For accessories, important part, for accessories, spare parts and tools. At times we have seen that say for example, if you are importing mobile, so mobile is there, but along with that there are certain accessories. Earplugs are there, there is a charger which is there. So similarly, there could be any type of item which you are importing, and there are various accessories, or there are some spare parts, or there are some tools with respect to that, if there are some industrial goods or something like that. So in that case, it is quite possible that the actual item, say for example, mobile phone is originated there but by that particular manufacturer in the other country. But the spare parts which he is putting in that box, the tools which he is putting in that box when he is exporting, those could be possible that those he might have imported from some other countries. Okay, so these rules govern, the rules pertaining to accessories, spare parts and tools govern those kind of situations. So the rule says that they have to be treated as the accessories, spare parts and tools have to be treated alike to the main item. So if your main item is qualifying for the certificate of origin, then accessories, spare parts and tools will also qualify for the certificate of origin. And so there'll be no two separate certificate of origins that you will be receiving, but while applying for the certificate of origin, you will be mentioning that along with my main item, I'm also giving accessories, spare parts and tools, and the authority will consider them subject to the conditions which I'm now going to mention. That they are not invoiced separately. There should be no separate value for those. You're not charging them separately. So if you're charging for the mobile, it's a mobile phone, and the accessories or spare parts or tools, they are going along with that mobile in one box only, and they're part of that mobile value only. There is no separate value, no separate invoice for those accessories, spare parts and tools. It's customary for the export product. It should not happen that a person otherwise, we are so smart people that what we will do is otherwise, okay, we will not invoice it separately. We will include in that value only, but we will combine 10 different kind of products, out of which one will qualify. We will say this is the main product, and the other two are the accessories and the spare parts or the tools, and then we will export it. So it says nothing doing. It should be customary for the export product. It should be normal practice that these kind of finished products are being sold along with these kind of accessories, spare parts, tools. It should not be something out of the box and new thinking of some person that he combines 10 different things into one package and shows to the authorities that these are the, even though his finished product is one only, and he's saying that no, I want the certificate of origin for all the 5 items that I've combined in this particular package. Value taken in calculating the value addition of the export product. This is also important. So even though they're not invoiced separately, even though you're not charging your buyer separately for the accessories, spare parts and tools, but the value of those accessories, spare parts and tools have to be taken in consideration while calculating the value addition of the export product. So meaning thereby, if that accessory, spare part or tool is being procured by a manufacturer, say from some other country, then in that case, those accessories, spare parts, tools, they become non-originating material. So if they are non-originating material, then accordingly the value of those have to be included while taking the doing the calculation for the finished product. So typically, if your finished product requires a value addition of 40%, then that 40% should be achieved. But definitely, the authorities will consider giving you a certificate of origin for accessories, spare parts, and tools invoiced along with, not invoiced, but given along with the main item. But for that, the value has to be taken into the calculation. Third, there is a specific provision in the agreement pertaining to third-party invoicing, wherein it says that details of third-party invoicing is allowed for the benefit to be given to the importer. However, there's an important condition that details of that third-party invoicing should appear mandatorily in the certificate of origin. So if there are no details of third-party invoicing in the certificate of origin, the authorities definitely, because they don't know whatever data, whatever thing you give to them, the data what you give to them, they will issue the certificate of origin basis that. But then the benefit by the importer, that will be denied to him. And definitely, I hope you all know that every certificate of origin, it contains the date of invoice. So definitely at that column particularly where it says the invoice number, invoice date, invoice issued by. So if any third party has issued you the invoice, it's a case of bill to ship to model, then in that case, that third party invoicing should appear. However, the goods manufacturing should qualify within UAE only. So say if my invoicing for those goods is being done from Singapore, but the goods are being manufactured in UAE, they will be shipped from UAE directly to my country here in India, directly to me. So in that case, that will be allowed. The benefit would be given to me. It cannot be a vice versa case that the billing is being done from UAE and manufacturing is taking place in Australia. And for that, if I say, no, you give me the benefit will not be given, because there, in that case, the goods are not being manufactured in UAE, the goods are not being imported from UAE, the goods are not being consigned from UAE. So in that case, benefit will not be given. Third party invoicing, when we say, it means that the invoicing can be done from any other country also, apart from the two contracting countries, two contracting parties. But the conditions of all other conditions will have to be fulfilled by the manufacturer in a particular country. So this is allowed. This is transshipment, which partly I've dealt in the previous slide also. So this is allowed without any customs clearance. So let me get back to my previous example, wherein I said that say the goods are manufactured completely in UAE from the domestic raw materials they have manufactured it. So it's 100% value addition what they have done there. There is nothing which is there, but there is some minor process which typically has to take place in, say, Singapore, and then the goods have to move to India. So I told you that this kind of transaction will not be allowed, and the benefit will of the this agreement will not be given on these kind of transactions. However, if there is a transshipment case, so say there is some bonded warehouse in Singapore, and in that case, you can import the goods into Singapore and keep them in the bonded warehouse, do that minor processing there, then get the goods to India. In that case, because there is no customs clearance which has taken place in Singapore, so in that case, the benefit of the CEPA agreement, this CEPA between India and UAE, would be given to the imports. So it is allowed if there is no customs clearance, whether for minor processing, whether you are just storing as a warehouse in a bonded warehouse in some other country, that's also quite possible, or whether just because of the transshipment due to the vessel change, if that has happened, that is also allowed. So, but the important point is that there should be no customs clearance. If there is no customs clearance in the other country, then in that case, the benefit will be allowed. And in fact, let me tell you, if there is transshipment cases and all, these details also normally for other countries, I have seen practically that these details also that the goods are being shipped to transshipped at, and these details are also normally coming on the your bill of entry also, and your certificate of origin also. Now I'm coming to the way forward. Now, these were the basic terms, basic agreement pertaining to the trade in goods that we have dealt. Apart from this, like this is pertaining to only goods, but apart from this, the customs angle also, there is a complete chapter which talks about customs facilitation and all. So they also say that, like when I'll give you an example, like AU in India, the exporters, importers, they obtain the AU certificates for themselves, but then these AU certificates are limited to India. They're not recognized elsewhere in the world. So there are countries which say that your suppliers should also be AU compliant, or some particular regulation compliant, like CTPAT compliant or something like that. So in that case, Indian AU, which is an equivalent to the terminology, the procedures, what they follow in their country, but they don't recognize the Indian AU. So here in this agreement, it is also provided that the government between the two nations shall make endeavor to enter into mutual recognition agreement, which we, in normal layman language, which we say MRA between these two countries pertaining to the AU recognition also, and various status holder recognitions also. But as of now, it just says that the countries shall make endeavor. There is no such conclusiveness on this. And in fact, till now, if I say India has 3 MRAs typically for AU recognition. One with, I think, Hong Kong, the other is with Taiwan, and then the third one is, I guess, with some South Korea or something like that. So basically what I mean to say is, since this being a CEPA, this is very, very comprehensive, and it talks about each and every measure wherein the countries, this is a very, very brief I have dealt in, very, very brief, because the time does not permit so. It's a very, very long agreement, 880 pager agreement, and therefore I'm saying again that if we are to deal in all the things, it will not be possible. But here in this particular thing, they have actually endeavored on each and every aspect to come out on which they could settle. They have done it right now. In which they could not settle as of now, they have written something like that both the countries will endeavor to make facility for the mutual recognition, make facility for the investment, make facility, means there are many, many places where they have done like this. Also importantly, one more point, as of now, they are saying that as of now, it will be the paper-based certificate of origin which will be valid. But going further, a timeline of 2 years has been prescribed, which says that in that 2 years time period, the governments should make endeavor to provide such kind of a portal wherein the certificates of origin can be transferred from one authority of one country to the other authority, to the authority of the other country. So timeline for that has been kept as 2 years, and thereafter a third provision is also provided for self-certification also. So similar, but when that will come, that is not known, the self-certification procedure. I guess self-certification procedure would be something similar to the regs which we have now for the European nations. wherein then exporter can himself certify that his goods meets the criteria of the origin as per this and this agreement. There is no need to get any agreement, no need to get any certificate of origin from the authorities going around them, and there's no need for that in that case. But that is far away in this, because there is no timeline fixed as to when it comes, nobody knows. But yes, timeline for 2-year period for opening up the window, the portal wherein the trades, the certificate of origin can be transferred online, that is being provided. Now, after knowing the basics of as to how this certificate of origin, goods, customs, duties, value addition criteria works when a FTA or a CEPA agreement comes into picture. So what should the companies exactly do? What is their way forward as to how they should think further? So one is that exploring the opportunities to trade with UAE. I'm not saying here that the company should think of manufacturing those items which are now in the UAE, and earlier UAE CEPA, and earlier they are manufacturing some other products. But here what I'm trying to say is that companies should explore if they are importing or exporting the goods to, let's say, they're importing the goods from some other countries, raw materials from some other countries, or normally also importing from some other countries, and wherein they're paying the duties. If they now have any vendor, any seller there in UAE who provides at competitive prices the raw materials or the goods, so in that case the companies can think of switching their buyers from other countries to UAE now. Contract restructuring negotiations with the trade partners in UAE. So if currently, if the companies, they are already having dealings and trade partners in UAE for buying or selling of their items, products. So in that case, because earlier the benefits were not there, there were full customs duties which were being levied, which was a cost to the importer in all cases. So now the companies can do the contract restructuring also, negotiations also with their trade partners, given the number of tariff lines, 97% of the tariff line benefits to be given from Indian side, from UAE side, and 90% of the tariff line benefit to be given from the India side. So they can think of the contract restructuring and negotiation also. Third is a review of the information filled by the CHAs. This is very, very important, extremely important. The point is, merely by you understanding the provisions of CEPA, merely by the other partner country giving you the certificate of origin, will not suffice for you to take the benefit unless and until the correct information is filled in by the system, by the CHAs. So the point is that they should be well aware of the this CEPA between India and UAE as to how they have to fill, because now the bill of entry, there is a mandatory column in bill of entry wherein you have to declare whether you are taking the benefit of any certificate of origin or no. You have to mention the notification number also, whether any benefit of the notification for or these FTAs have to be taken on. So they have to, be very, very careful in filling the bill of entry. If you're not claiming the benefit in bill of entry, later on, either at that point in time or later on, the importer might land up in trouble and might have to pay the duties, and along with the, of course, interests and penalties. Next important thing is educating the employees regarding the procedural aspects so that benefits are rightly reaped with less legal hassles. Here I would say, because this is my practical experience, we have seen at so many places that the employees per se, when it comes to taking the certificate of origin from both the sides, whether it's from the exporter's side, whether it's from the importer's side. So if it's from the importer's side, the employees are also not so much guided as to how they have to actually take up this benefit. And one very simple example, I would say, it's not only filling up the bill of entry form by the CHAs. It's the filling up of form A as per the Carota rules also correctly. And the questions in Carota rules, the form A, they're very, very sophisticated. And that is a typical declaration which is being given by the importer. So it has to be employees need to be really very, very careful in giving those kind of declarations and information in Form A to the department to claim the benefit. Because we have seen that many a times at that point in time, sometimes the benefits are given and goods are cleared. But after few months or few years, the department will again come to them and say that this thing is opened, investigation is going on, and you have not filled the Karotar form properly, and therefore the benefit will be denied to you, even despite the fact you are having a certificate of origin, you have declared it in the bill of entry also, your manufacturer has also fulfilled all the, definitely it's not a fake certificate of origin, it's just that there was no proper documentation in Form A. It's just because of that. So, and then obviously at lower levels, you don't get the benefit. You have to fight and you have to go in for litigation to get the benefit. Definitely in litigation, you get those benefits on the basis that these are just merely procedural lapse as long as everything else is in place. But definitely one has to make an effort for that. So this is very, very important aspect. This is from the importer's side. Similarly, from the exporter's side also, while getting the certificate of origin, as to what kind of data they need to give to the authority, how they have to liaise with the authority in getting the certificate of origin. Because here in India, if I say it's a very, very casual approach for the certificate of origin. You just fill up, you just give your cost sheet and other details, go there, I would not officially say do what, but then can get the certificate of origin. And tomorrow, if there is anything which comes out wrong, then you are also suffering, and your importer is also suffering. So there are very, very so at least do whatever you want. But the point is that the documentation with respect to all the declarations, with all the paperwork, should be perfect. And for that, it's very, very important to understand the law in first place. What is the law? Only then you can make the documentation proper. Any questions still here? No questions? So with this, if there are no questions, can everybody hear me?